Hello, everyone. Welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well as we continue to ease out of lockdown. I'm pleased to have with me once again Mark Shields, investment manager from Brooks Macdonald, and we will be answering a few of your topical questions. Welcome, Mark.
Hello, Brian.
Okay. Mark, investment markets have been quite favourable of late, but there's quite a lot of talk about inflation. How do you see this affecting investments going forward?
Yeah, I mean, inflation is a real hot topic at the moment with regards to markets in general. And in fact, as we're speaking at the moment, Brian, we very recently had some data out from the US that showed that CPI data from the US was 5.4% in June on an annualized basis. And indeed, this morning we had other data from the UK showing that CPI in the UK was 2.5%, both of which were quite substantially ahead of expectations, and quite a long way ahead of where we were even 18 months ago, or expectations for where we were going to be 18 months ago. Now, this is mainly being driven by a sort of resurgence in economic activity delivered by the dropping or reduction in constraints imposed on economies by the COVID situation we encountered or still encountering. The issue, of course, is more the impact that this can have on various parts of the investment market. Equities become less favorable in a higher inflationary environment. Certainly higher growth equities do, because they are based off of a lower risk-free rate. But the bigger impact is probably on the bond market. And the concern really is that if you get a higher inflation, that puts more pressure onto bonds, and you get an environment in which equities and bonds are moving in lockstep, which is not really what we want in a diversified portfolio. However, our thoughts on this is that the inflation data we're seeing at the moment is transitory. We expect this to remain elevated, this inflation data to remain elevated, probably going into the autumn, if not maybe for the rest of this year. But we then expect it to at least moderate and start to decline in 2022. So we think that this probably takes pressure off of central banks from actually taking any sort of significant policy changes that could unsettle markets. And in fact, that's exactly what we're hearing from central banks as well, that they are willing to tolerate a medium-term picture or environment of higher inflation, because they believe that this will moderate going out into 2022. So yes, at the moment it is quite topical. Yes, the inflation rate is elevated at the moment, but we expect it to moderate, and we expect the impact to be fairly limited over the longer term.
Okay, so with inflation going up, as expected, do you see interest rates not moving in the short term? Is that effectively how you're viewing it, Mark?
Correct. At the moment, we do not expect central banks to be taking significant policy movements, which would include interest rate rises. We don't expect them to do that anytime soon. We think that they are still suggesting to markets, and data still suggests that they are willing to look through this period, and interest rates will not go up in the near term, unless we see the situation fundamentally change in some way, but we don't anticipate that.
Okay, fine. Moving then slightly into the COVID situation, how do you see the easing of the restrictions in England impacting investment portfolios, Mark?
Yeah, I think in general, this the easing of restrictions probably has to happen at some point, and I do agree with the notion that we are going to have to sort of live with COVID, as it were, in that it's probably going to become part of an annualized vaccination program, very similar to what we have got quite used to with seasonal flu. I think that probably needed to happen at some point. As to the timing of it, that does make me a little bit nervous, given the rate at which we are seeing cases increase at the moment. And indeed, I think the idea of all restrictions being sort of thrown out the window is a little bit silly, when actually some of those measures, such as mask wearing, to my mind, cause very little issues and is shown to be relatively effective. In terms of how we anticipate this affecting portfolios, well, actually, on the sort of rosy case scenario, we have been sort of buying in a little bit into the economic recovery story. So we've been topping up positions in the UK. We continue to think that the vaccination program, combined with relatively cheap assets that can be bought in the UK, makes it quite compelling in the UK at the moment. So we have been adding to domestic equities. And if this program of continued easing is shown to be relatively successful, if we don't have a spike up in hospitalization or indeed any other further issues with regards to that, then I think this should be fairly positive, frankly, because I think it shows that the end is in sight. Of course, the other side of the coin is that if we do see a larger impact or unexpected impact onto the into the populace, then we may see further restrictions be reimposed once more. Although I sort of suspect that going back to a full lockdown is probably very unlikely at this point in time. I think maybe this is a step towards people beginning to realize that we are coming towards the end of this situation, hopefully, with and increased sentiment and improvement in people's outlook, which is probably quite positive, I would suggest, within reason.
Okay. And thinking of it on a wider basis, Mark, thinking of the geopolitical situation that we're in at the moment, how do you see that impacting investment markets?
Yeah, I mean, it's always a tricky one trying to look at geopolitical risks, but again, I think we've had a very sort of calm period, as it were, post. Obviously, we've had the COVID situation, but then we had the U.S. presidential election with Joe Biden coming in at the early part of this year. There was some disruption around his inauguration, if you recall, but since then, I think there's been a sort of a reduction in investors' sort of anticipation of geopolitical risks, partly because he's considered much more sort of a statesman than someone like Trump ever was, and is unlikely to inflame geopolitical tensions. However, we have started to see some risks geopolitical risks, that is, beginning to re-emerge, mostly around areas such as China. There's been further friction between the US and China. China has sort of always had places like Taiwan in its sights, quite simply because it sort of feels that it's a sort of errant province that needs to be brought to heel. Never really recognized it as an independent country. Now, the likelihood of some sort of military intervention or something in Taiwan is probably quite remote. We don't really sort of expect that to happen, but it could well build up to that sort of situation. And indeed, it's being exacerbated at the moment by the fact that we're seeing a global shortage of semiconductors, chips, and Taiwan is the major manufacturing point of semiconductors. So there is a situation in which any sort of tension there between China and the US and Taiwan could have further impacts onto the supply chain of a highly complex supply chain of a key manufacturing base. But away from that, I think there are other risks that are worth mentioning. Very hard to predict, as I said. Cyber attacks are becoming more and more common and larger in scale, and we continue to think that actually there is possibility of a major cyber attack causing significant disruption. Political risks within emerging markets in particular can have significant impacts at the moment. And also we've seen a lurch to the left with regards to some developed markets as well. And that may well be a trend that we continue to see, offset slightly by the populist movement as well. So I think we've had about sort of 6 or 7 months where geopolitical risks have very much played a sort of back foot, as it were, but they're beginning to re-emerge, and it's something very much for us to keep our eyes on, because these things can develop very rapidly, and when they do have an impact, they can have a significant impact, although it can be hard to position portfolios to protect against them.
Okay, quite a lot of information there to take in, Mark, and good that you're running an actively managed portfolio for us. Okay, that's good for now. I'm going to thank you, Mark, for your input there, and I'm going to thank you also for watching. Hope it was of interest, and as always, if you have any questions or queries, please be in touch with us. Thank you.